Every single time in history that silver has done something that people said was impossible, something they laughed at, something they dismissed as fantasy, the people who ignored those warnings and just quietly held their silver ended up winning. Every single time. And right now, in March of 2026, the most respected banks on the planet, Citigroup, JP Morgan, Bank of America, are saying something that just a year ago would have gotten you thrown out of any serious financial conference. They are saying silver could hit $150 per ounce, maybe even $170. And they are not fringe analysts. They are not newsletter writers trying to sell you a newsletter subscription. These are the biggest, most powerful financial institutions in the world. So today on Money Secrets, we're going to answer the one question that every investor in America is asking right now. Silver is sitting around $96 per ounce as of today, March 8th, 2026. Is $150 actually possible? And, more importantly, is the opportunity still there for regular people? Or has the train already left the station? Because what I am about to show you in the next 16 minutes might completely change how you think about silver forever. And before we go any further, if you have not subscribed to Money Secrets yet, do it right now. Hit that subscribe button and tap the bell icon. We are covering the most important precious metal story of this decade in real time, and you do not want to miss a single update. Now let us get into the real story. Let me start by giving you some context that will completely reshape how you look at these numbers. Because when you hear $96 per ounce for silver, and then you hear the target of $150, it is tempting to think, okay, that is a big jump. That seems unrealistic. But here's the thing. Just 14 months ago, in January of 2025, silver was trading at about $28 to $30 per ounce. Let that sink in. Silver went from roughly $30 in early 2025 to breaking $100 in January of 2026. To hitting an all-time high of $120 per ounce on January 29th of 2026. That is a move of over 300% in just 12 months. It surged by 165% in 2025 alone, making it the best performing major asset class on Earth last year, beating gold, beating stocks, beating crypto, beating everything. And the people who held silver through that entire move did not do it by accident. They did it because they understood something fundamental about why silver was going up. And that same fundamental story, the same engine that drove silver from $28 to $120, is still running. It has not stopped. If anything, it has gotten more powerful. And that is exactly what the biggest banks in the world are now saying publicly. Citigroup, one of the most powerful banks on earth, issued a forecast in late January of 2026 that silver would reach $150 per ounce by the second quarter of 2026, meaning by the time we hit June or July of this year, Citi believes silver could be trading 56% higher than where it is right now. They called silver, in their own words, gold on steroids. And they went even further. If the gold-silver ratio, which we will explain in a moment, returns to its 2011 low of 32 to 1, Citi says silver could reach $170 per ounce. That is not a typo. $170 from a major international bank. Jim Wyckoff, a prominent and highly respected market strategist who has been covering commodities for decades, has also publicly outlined a path to $150 silver in 2026. And Anthony Milewski, the senior analyst at the Oregon Group, said, and I'm going to quote him directly here, while a $150 silver price is an aggressive scenario, the combination of constrained supply, industrial demand growth, and macroeconomic uncertainty makes it worth serious consideration. These are serious people making serious arguments. And today at Money Secrets, we are going to walk through every single piece of this argument so you understand exactly why this is not fantasy, what would have to happen for it to become reality, and what the real risks are if it does not play out the way the bulls expect. Let us start with the supply side of the story, because this is something that almost nobody in the mainstream financial media talks about, and it is arguably the most important piece of the entire silver puzzle. Here is the reality. Silver has been in a supply deficit for 5 consecutive years. That means demand has exceeded supply every single year since at least 2021. According to the Silver Institute, silver demand reached approximately 1.17 billion ounces in 2024, while mine supply fell significantly short of that number, leaving a deficit of roughly 150 to 200 million ounces that had to be met by drawing down existing above-ground stockpiles. Now here is why this matters so much. When any commodity is in a supply deficit, the only way to balance the market over the long term is for prices to rise high enough that either demand gets destroyed or new supply comes online. But silver supply does not come online quickly. Mining is slow. Opening a new silver mine from scratch takes anywhere from 7 to 15 years. from exploration to permitting to construction to production. You cannot just turn a tap and get more silver instantly. The world has been drawing down stockpiles for 5 straight years, and the stockpiles are getting noticeably thinner. Dana Samuelson, president of American Gold Exchange, explained in early 2025 that the London Bullion Market Association's physical silver supplies had already decreased by 30 to 40%, while gold supplies in the same vaults had only decreased by 3 to 4%. That is a dramatic thinning of the physical silver market. And as of January 2026, something else happened that has added a massive new wildcard to this already tight supply situation. China, which is one of the world's largest refiners and exporters of silver, implemented export restrictions on refined silver that went into effect on January 1st, 2026. This is not something that got a lot of attention in the U.S. financial press, but it is a potentially enormous development for the global silver market. China has essentially started limiting how much refined silver can leave the country, and China has been a major source of physical silver supply for international buyers for years. If that supply channel gets restricted, the already tight global silver market gets even tighter. Some analysts have specifically pointed to China's export restrictions as the potential supply shock that could drive silver not just to $150, but possibly beyond. Combined with the 5-year supply deficit, the thinning of physical stockpiles in London and other major vaults, and the explosive growth in industrial demand that we are about to get to, the supply picture for silver looks increasingly like a coiled spring that is getting more and more compressed. Now let us talk about industrial demand, because this is the part of the silver story that makes it completely different from gold, and in many ways makes the bull case for silver even more compelling than the bull case for gold. Approximately 50 to 60% of all global silver demand is now industrial. Silver is used in solar panels, electric vehicles, AI data center infrastructure, advanced semiconductors, medical devices, 5G networks, and a massive range of other applications. And the growth in each one of these areas is not slowing down. It is accelerating. Let us start with solar energy. Solar panels use silver as a conductive material in the photovoltaic cells that convert sunlight into electricity. As the world has ramped up solar panel production at an extraordinary rate over the past decade, silver demand from the solar industry has risen by nearly 4 times. And according to the International Energy Agency, solar capacity is expected to expand by 3,200 to 4,400 gigawatts globally by 2030. Every single one of those gigawatts requires silver. This is demand that is not speculative. It is not driven by fear or greed. It is driven by government policy, climate goals, corporate energy commitments, and pure economic logic, as solar becomes the cheapest form of electricity generation in history. The solar industry alone is going to need more silver every year through at least the end of this decade, regardless of what happens with wars, tariffs, or interest rates. Then there are electric vehicles. EVs use 67 to 79% more silver than traditional internal combustion engine cars. As EV adoption accelerates globally, and it is accelerating, driven by falling battery costs, government mandates, and consumer preference shifts, the silver demand from the automotive industry is projected to grow at a rate of 3 to 4% per year through 2031, according to Silver Institute estimates. By 2027, silver demand from EVs is expected to surpass silver demand from traditional combustion engine vehicles. This is a structural, irreversible shift that is going to keep pulling more and more silver into cars over the next decade and beyond. And then there is artificial intelligence. This is the newest and perhaps most explosive driver of silver demand, and it is one that even many precious metals analysts have not fully priced into their models yet. AI data centers require massive amounts of silver for the hardware that powers them. Multi-layer ceramic capacitors, conductive pastes in chips, connectors, circuit boards, and other components that all require silver for its unique electrical conductivity properties. The global AI infrastructure build-out that is happening right now is genuinely unprecedented in its scale and speed. Every major tech company, Microsoft, Google, Amazon, Meta, is spending hundreds of billions of dollars building out AI infrastructure. Every one of those data centers needs silver. And unlike the solar and EV demand, which has been building for years and is well understood, the AI silver demand is just beginning to show up in the data. It is an additional demand driver piling on top of an already supply-constrained market. So let us put this all together. You have 5 consecutive years of supply deficits. You have physical stockpiles in major vaults declining dramatically. You have China restricting silver exports. You have solar, EV, and AI driving industrial demand higher year after year. And then on top of all of that industrial pressure, you have the investment and safe haven demand story that we talked about in our recent gold video, the US-Iran war, the 15% tariff ruling, the inflation pressure, the dollar weakness, central bank concerns about fiat currency, and the broader de-dollarization trend. Silver gets hit by every single one of these forces simultaneously. That is why the move from $28 to over $100 happened. And that is why serious analysts are not backing away from their $150 targets even after the sharp pullback from the January highs. Now let us talk about the gold-silver ratio, because understanding this concept is crucial to understanding why so many analysts are confident in higher silver prices and why the math genuinely supports a much higher price from current levels. The gold-silver ratio is simply the number of ounces of silver it takes to buy 1 ounce of gold. Right now, with gold trading around $5,100 to $5,200 and silver trading around $90 to $96, the ratio is roughly 55 to 58 to 1. That means 1 ounce of gold buys about 56 to 58 ounces of silver at current prices. Now here is the crucial historical context. Historically, throughout most of the modern era, the gold-silver ratio has averaged somewhere between 45 and 60 to 1, but during major precious metals, bull markets, when both metals are rising strongly, the ratio typically compresses toward the lower end of the historical range and sometimes below it. In 1980, during the last major precious metals bull market, the gold-silver ratio compressed all the way down to around 15 to 1 before the blow-off top. In 2011, the last time silver had a significant bull run, the ratio compressed to about 32 to 1, which is exactly the scenario Citigroup cited in their $170 price target. What does this mean in practical terms? If gold stays at $5,200 and the ratio compresses to 50 to 1, silver would need to be at $104. If the ratio compresses to 45 to 1, silver needs to be at $116. If it compresses to 40 to 1, silver needs to be at $130. And if it compresses to 32 to 1, the level it reached in 2011, silver would need to be at $162 at current gold prices. This is the mathematical framework behind the $150 price target. It is not random optimism. It is based on the historical relationship between these two metals during bull market cycles, combined with fundamental supply-demand analysis. Now here at Money Secrets, we always give you both sides of the story, and there are real risks to the silver bull case that you need to understand if you are thinking about this as an investment. The first and most important risk is that silver pulled back sharply from its $120 January high. As of right now, silver is trading in the low to mid-90s, having given back almost 30% from its peak. That kind of volatility is exactly what makes silver both exciting and dangerous. The pullback happened for several reasons. Concerns about a global manufacturing slowdown driven by tariff uncertainty, some profit-taking by institutional investors who had been sitting on enormous gains, and technical selling after the sharp spike toward 120. Bank of America actually ranked silver as the asset with the most bubble-like characteristics in a January analysis, suggesting that at $120, the metal had gotten ahead of even its strong fundamentals. That is a serious warning from a serious institution, and it cannot be dismissed. The second risk is the industrial demand component that we discussed earlier. Silver's industrial identity is a double-edged sword. On the way up, it amplifies the bull case because you have both investment demand and industrial demand pushing in the same direction. But in a recession or a significant global manufacturing slowdown, which is actually a real possibility given the tariff environment and war-related economic uncertainty, industrial demand could contract, and silver could fall harder than gold. If factories slow production, if EV sales disappoint, if AI spending gets cut, all of these scenarios would reduce silver's industrial demand and could cause a sharper correction than gold would experience in the same environment. Third, if the Federal Reserve unexpectedly pivots toward interest rate hikes in response to inflation, which is not the base case but is a real risk given how hot inflation is running right now, or higher real interest rates would be bearish for both gold and silver. Silver would likely feel the pain more sharply due to its higher volatility. And fourth, if the US-Iran conflict de-escalates faster than expected, if a ceasefire or diplomatic resolution happens in the next few weeks, some of the geopolitical safe haven premium that is currently baked into both gold and silver prices could unwind quickly, causing another sharp pullback. These are not reasons to panic. They are reasons to be honest about the risk and manage your position accordingly. But here's the thing. The bears have been saying silver was in a bubble since it was at $50. They were saying it was in a bubble at $70. They were saying it at $100. And yet the structural forces driving this market, the supply deficit, the China export restrictions, the industrial demand from solar, EVs, and AI, the central bank gold buying that is pulling investment attention toward the entire precious metals complex, the inflation environment, the dollar weakness, the geopolitical uncertainty. None of these forces have gone away. In fact, most of them have intensified since the beginning of the year. The pullback from $120 to the 90s looks less like the end of a bull market and more like the kind of healthy consolidation that major bull markets and commodities have experienced multiple times before continuing higher. That is at least how the bulls see it. And with Citigroup publicly targeting $150 by Q2 of 2026, meaning within the next few months, the bull camp is not exactly backing down. Let me tell you something that really puts this entire silver story into perspective. The Silver Institute's data shows that silver demand has exceeded supply by 150 to 200 million ounces every single year for the last 5 years. That is a cumulative deficit of somewhere between 750 million and 1 billion ounces over the last 5 years alone. That metal has to come from somewhere. It has been coming from above-ground stockpiles, from the vaults in London and New York and Shanghai that hold the world's physical silver. Those stockpiles are getting depleted. And when stockpiles run low enough, the market hits a physical crunch. A moment where buyers who need actual metal cannot find it at current prices and are forced to bid aggressively higher to attract sellers. This is the scenario that precious metals analysts refer to as a supply shock. And it is the scenario that could drive silver not just to $150, but potentially to prices that most people today would consider completely unthinkable. We're not predicting that this will happen, but we're telling you that the conditions for it to happen are more clearly present today than at any other time in the last 40 years. So where does that leave us? Here is the clean picture as of today, March 8th, 2026. Silver is trading around $90 to $96 per ounce, roughly 20 to 30% below its all-time high of $120 set on January 29th. Citigroup has a target of $150 by Q2 2026, with a stretch target of $170 if the gold-silver ratio compresses back to 2011 levels. Gold-silver's lead analyst, Alan Hibbard, expects silver to trade above $100 on a sustained basis as supply deficits deepen. Jim Wyckoff, veteran market strategist, has outlined a path to $150 as the next major leg higher, with a new floor in the $65 to $70 range for the entire market. The Oregon Group's Anthony Milewski calls 150 an aggressive but seriously worth considering scenario, given the constellation of supply, demand, and macro forces. And from the bullish extreme, technical analyst Michael Oliver has outlined scenarios of $100 to $200 silver, though even silver bulls would acknowledge that $200 would require an extraordinary combination of events, all breaking in silver's favor simultaneously. The structural bull case, supply deficits, China export restrictions, solar and EV and AI industrial demand, inflation, dollar weakness, geopolitical safe haven buying, all of these remain firmly intact. The main short-term risk is that silver's industrial component makes it more vulnerable than gold to a sharp reversal if recession fears intensify or trade war damage to global manufacturing becomes more severe. Now I want to hear from you directly. Are you holding silver right now? Are you watching from the sidelines trying to decide if you missed it? Or are you in the bear camp thinking this is all a bubble that is about to pop? Drop your answer in the comments below. Tell me what you think silver does in 2026. Does it hit 150? Does it fall back to 70? Does it do something completely unexpected? Every single comment on this channel gets read. Your perspectives are genuinely valuable and they shape the content we create here at Money Secrets. So do not just watch silently, say something. Your comment might start a conversation that helps another viewer make a better decision about their financial future. And if this analysis gave you new information or a new way of thinking about silver, if it helped you see the full picture instead of just the headline price, then please share this video. Share it with a friend who is thinking about precious metals. Share it with someone who is worried about inflation. Share it with anyone who wants to understand what is happening in the financial world right now, because the silver story of 2026 is one of the most important financial stories being told anywhere on Earth right now. And you now understand it better than 99% of people do. That is the goal here at Money Secrets, not just to tell you what is happening, but to make sure you truly understand why it is happening. So share this with someone who deserves to know. Hit the subscribe button if you have not already, and turn on the notification bell. Because we are going to keep tracking silver, gold, the war, the tariffs, the Fed, all of it. And we are going to bring you the clearest, most honest analysis we possibly can every single week. Stay smart, stay informed, and we will see you in the next video.